The first collapse never looks like a design. It feels like chaos, screaming tickers, frozen banks, and a nation watching its own reflection crack. But every era has its breaking point, and America's always come with the same sickening sound: debt snapping under its own weight. The panic of 1907 was no different. One season, Manhattan was glowing with confidence. The next, fear spread faster than any wildfire. Withdrawals surged. Banks shut their doors. Men who thought they owned the world realized they didn't even own their deposits. And in the choking silence that followed, a truth began to surface. Collapses don't just happen. They clear the stage. Because whenever America falls, someone rises. The newspapers at the time called it an accident, an unfortunate storm of speculation, mistrust, and mismanagement. But what they didn't print was the deeper wound. The financial system was fragmented by design, fragile by intention, and one spark away from a full reset. And resets are where power rearranges itself. In 1907, it rearranged violently. Markets convulsed. Credit evaporated. Panic spread through the country like a shadow swallowing the coastline. Factories dimmed. Families hoarded what they could. The nation braced itself against an invisible enemy that moved through ledgers, not battlefields. Yet even as America trembled, a small circle of men watched the collapse with a different kind of clarity, because they knew what would come next. They always do. Crises rewrite rules. Crises justify new powers. Crises make the unthinkable necessary. And in the ruins of 1907, the perfect narrative was taking shape. The system must be saved, even if saving it means giving unprecedented authority to those who stand above it. Decades later, the story repeated itself. 1929, a fall so catastrophic it carved scars into generations. One morning, the stock market was a monument to prosperity. The next, it became a graveyard of fortunes. People leapt from windows, banks folded, bread lines stretched across streets that once symbolized the American dream. But behind the heartbreak was a familiar pattern: instability becoming opportunity for consolidation. Each failure pushed the country deeper into dependence on a central hand that promised safety at the price of freedom. And then came 2008, a collapse so global, so interconnected, that it revealed the true architecture of modern finance. A web controlled by a few, influencing millions. Homes vanished, pensions evaporated. Entire cities felt the shockwave. But while the public drowned in losses, the architects of the crisis were rescued, bailed out, stabilized, protected, because the system couldn't survive without them. That is the story told over and over. When the people fail, they fall. When the elite fail, the system shields them. Every collapse sharpens the same question: who benefits when America breaks? Because if the destruction were truly random, the aftermath wouldn't look so orderly. Control wouldn't tighten with each catastrophe. Power wouldn't pool into fewer and fewer hands. And yet, that is exactly what happens. After every crisis, the same institutions emerge stronger, more centralized, more essential, until their influence becomes invisible, like the air the economy breathes. This is the uncomfortable truth the history books soften. America's greatest financial disasters didn't just expose weakness, they created opportunity. Opportunity to shift authority, rewrite structures, consolidate money flows, and elevate a single institution that would one day dictate the rhythm of the entire nation. By the time the dust settles in each era, one message is quietly accepted. The system failed because it wasn't centralized enough. The crisis happened because someone else had too much power, not because one entity was gaining it. But step back and another picture emerges, one far darker, far more deliberate. Crises are not just moments of collapse. They are invitations to build something new, something bigger, something that can reach into every bank, every dollar, every life. And in 1907, as America gasped for air, that invitation was already in the hands of those prepared to answer it. Every crisis looks unique on the surface. New names, new numbers, new headlines. But underneath, the same skeleton keeps revealing itself. A pattern carved into the architecture of American finance long before the public ever noticed it. A rhythm of expansion and destruction. A choreography of hope, excess, collapse, and consolidation. And once you learn to see it, you can't unsee it, because it always ends the same way. More power flows upward. The pattern begins quietly, almost innocently. Credit loosens. Money expands. The economy brightens as if fueled by a new sun. Politicians celebrate growth. Newspapers praise innovation. Ordinary families are told this is the moment to invest, to borrow, to dream bigger. And for a brief season, everything works. Until it doesn't. Because expansion is not the goal. Overextension is. Inflation creeps in. Prices rise. Wages lag. The bubble swells. What feels like prosperity is actually pressure, building grain by grain. And while the public rides the wave, those at the top position themselves for the moment the water will inevitably recede. They know the cycle intimately. They've seen it for generations. They understand that the same forces that inflate wealth can also erase it with surgical precision. Then comes the break. Sometimes it starts with a rumor, a failed bank, a sudden drop in confidence. Other times, it's a spark in a distant market that ignites the entire system. But when the collapse finally hits, it hits with purpose. Credit freezes. Liquidity vanishes. Assets plummet. Families scramble, while institutions, those deemed too big to fail, tighten their grip. And just like that, the pattern shifts to its next phase: consolidation. In earlier eras, before the Federal Reserve existed, this cycle was even more brutal. Banks issued their own notes, manipulated supply, and often engineered scarcity to drive profits upward. Money wasn't just a medium of exchange, it was a lever of control, wielded by private financiers who understood the leverage of panic better than any politician. They created a world where crises were not misfortunes, but opportunities. And every collapse pushed small banks out of existence, leaving larger ones to absorb their assets, their power, their influence. The public endured the pain. The elite harvested the aftermath. What made the cycle so effective was its predictability. Expansion, euphoria, inflation, fragility, collapse, rescue, concentration of power. A self-perpetuating loop, disguised as the natural movements of the market. But markets are not natural. They are engineered environments, shaped by those who control the money that flows through them. Look closely at any major crisis in American history, and the same fingerprints appear. A shortage of liquidity at the exact moment dependence is at its peak. Institutions stepping in as saviors to problems they helped cultivate. Calls for greater oversight that somehow always mean surrendering more authority to a centralized force. And beneath all of it, a narrative skillfully woven. This was unpredictable, unprecedented, unavoidable. But the truth is harsher. These collapses follow a script, one designed to push the country closer to a single conclusion: the need for a powerful, centralized mechanism to regulate the entire financial structure. A mechanism that would one day become the Federal Reserve. By the early 20th century, the pattern had repeated so many times that the illusion of randomness shattered. The public saw chaos. The architects saw inevitability. And in the space between those two realities, a solution was prepared. One that would claim to protect the nation while quietly binding it to a system engineered for a very different purpose. Because once you recognize the pattern, the question changes. It's no longer, why do these crises keep happening? It becomes, who benefits every time they do? A century separates us from the world that birthed the Federal Reserve. Yet the game being played today is almost indistinguishable from the one orchestrated in 1907. The names have changed, the technology has evolved, but the mechanisms, the subtle levers of control, remain eerily familiar. History isn't repeating, it's looping. In 1907, a banking panic shattered public confidence and paved the way for a centralized authority to protect the nation from future crises. In 2008, a global meltdown did the same thing, but on a scale that would have been unimaginable to the early financiers who once gathered in secret at Jekyll Island. What used to be regional chaos is now planetary turmoil, and every shock only strengthens the institution that claims to be preventing them. Look closely, and the parallels become uncomfortable. Back then, the economy was throttled by liquidity shortages engineered by private bankers. Today, liquidity is created or destroyed at will by the Federal Reserve, a power so vast it can raise or erase trillions with a handful of keystrokes. In 1 century, control has shifted from scarcity to abundance, but the outcome is identical: dependency. When money tightens, the Fed is the lifeline. When money floods, the Fed is the architect. The illusion of choice disappears. The cycle remains. The early 1900s saw manipulation through interest rates, bank runs, and the strategic withdrawal of credit. The modern era simply upgraded the tools. Zero interest rates, quantitative easing, overnight repo injections, bailouts disguised as emergency liquidity programs. And each time the Fed steps in to steady the system, it expands the boundaries of its own authority. No vote required, no debate offered. Crises justify the cure, and the cure ensures the next crisis will be even larger. In 1913, the Fed was created under the promise of stabilizing the economy. But compare the charts. Volatility didn't fade, it multiplied. Booms grew bigger, busts grew deeper, and every collapse pushed the country further into the arms of the one institution supposedly preventing them. The Panic of 1907 led to the Fed's birth. The crash of 1929 led to its expansion. The inflation crisis of the 1970s cemented its power. The Great Recession in 2008 transformed it into a global central bank. By 2020, its reach extended beyond traditional finance into corporate debt, mortgages, and entire markets that were never meant to be under its command. When you lay the past and present side by side, the symmetry is unmistakable. 1907, a manufactured panic concentrates banking power. 2008, a systemic collapse concentrates all financial power. 1913, creation of a central authority. Today, dependence on that authority for every function of the economy. And through it all, one truth echoes. Each crisis moves America a step further from financial sovereignty and deeper into a structure governed by a small, insulated elite who operate behind the veil of monetary policy. Consider how the play unfolds now. The Fed lowers interest rates until the economy inflates like a balloon ready to burst. Asset prices skyrocket. Debt becomes the bloodstream of the nation. Then, inevitably, the tightening begins. Rates rise. Borrowers strain. Markets convulse. And when the collapse finally hits, the same institution that inflated the bubble steps forward to rescue the system it destabilized, consolidating even more influence in the process. The story hasn't changed since the days of Morgan and Rockefeller. Only the stage has. The parallel is simple and chilling. Then, the architects hid their intentions in private meetings on a secluded island. Now, they hide them in broad daylight behind press conferences and economic jargon. And yet the effect is the same. America's financial destiny drifts further from the hands of its people and deeper into a mechanism designed not to stabilize the nation, but to govern it. The past isn't behind us. It's the blueprint for the present. And if nothing changes, it will be the blueprint for the future as well. For decades, the story of the Federal Reserve has been wrapped in a comforting myth that it was built to protect the American people from the brutality of financial chaos. But peel back even one layer of that narrative, and the truth becomes unmistakable. The Fed was not born from democratic debate. It was engineered by a handful of men who understood one thing better than anyone else. Control the money, and you control the nation. The real origin of the Federal Reserve begins far from Washington, far from Congress, far from anything resembling public oversight. It begins in 1910 on a private train carrying a group of the most powerful financiers in American history, men whose names still shape the world today. Morgan, Rockefeller, Warburg. These were not public servants. They were titans of wealth, architects of influence, masters of leverage. And their destination was a secluded retreat off the coast of Georgia, Jekyll Island. The secrecy was absolute. No last names, no press, no public record. Men who competed ruthlessly in the open world suddenly collaborated in the shadows. Why? Because they weren't meeting to solve a crisis. They were meeting to design a system that would benefit from crises. Behind closed doors, they laid out the blueprint for what would become the Federal Reserve, a central bank that would appear governmental, function privately, and consolidate power in ways the public would never fully grasp. The genius of their design was its camouflage. The Fed would be presented as a stabilizing force, a guardian of the economy. But beneath the surface, it would operate as a cartel, protecting the largest banks, ensuring their survival, and embedding their influence into the foundation of the nation's financial architecture. The structure they built was not accidental. Regional reserve banks controlled by private interests, a board of governors insulated from voters, the power to create money, expand credit, and dictate interest, abilities so immense they shaped the direction of the entire country. And yet, the individuals who set this machine in motion would never stand for election, never face public accountability, never answer to the people whose lives their decisions would command. The revelation is this: the Fed was not designed to represent America. It was designed to manage America. Consider the beneficiaries across the last century. Every bailout strengthens the same institutions. Every crisis justifies greater intervention. Every intervention broadens the Fed's reach into new corners of the economy. Banks fail, the system protects them. People suffer, the system lectures them. When inflation rises, it's the public who loses purchasing power. When interest rates spike, it's the public who loses homes, jobs, businesses. But when major financial institutions teeter, the Fed acts with speed and precision, because their survival is foundational to the structure built in 1913. The institution claims independence, but independence from democracy is not protection. It is insulation. Look at the patterns. Who was rescued in 2008? The same giants whose reckless behavior fueled the crisis. Who gained unprecedented influence after COVID-era interventions? The same central entities guiding monetary policy. Who profits from an economy addicted to credit, liquidity, and perpetual stimulus? Not the worker, not the saver, not the citizen. The more you trace the lines, the clearer the picture becomes. The Federal Reserve is not a neutral referee. It is a power center, one created by elites, sustained by crises, and shielded by complexity. Its language is technical by design, its processes opaque by intention. Because confusion is a form of control. If people don't understand the system, they cannot challenge it. If they cannot challenge it, the machine continues uninterrupted. And that is the betrayal hidden in plain sight. The institution that shapes America's money was never built for the American people. It serves those who designed it. It protects those who profit from it. And it answers only to itself. The real owners of the money machine have never disappeared. They simply built a system where their influence no longer needs to hide. The truth about the Federal Reserve is difficult to face, not because it's complex, but because it's been hidden behind a century of carefully crafted narratives. Yet once you see the architecture of control, once you understand the pattern of crisis and consolidation, you realize something chilling. The trap was never meant to be temporary. It was meant to be permanent. A system that grows stronger with every downturn, every bailout, every twist of the economic knife. A system that quietly reshapes the destiny of a nation while convincing its citizens that nothing can be done. But inevitability is a strange thing. It can feel suffocating, like a prophecy no one chose. The Fed expands. Debt expands. Dependence expands. And with each expansion, America drifts further from the stability it was promised. This is the great paradox. The institution built to prevent disaster now relies on disaster to justify its existence. The money supply swells and contracts like a controlled heartbeat. Rates rise and fall with engineered precision. Markets dance to a rhythm set by hands the public never sees. And beneath it all, the average American carries the weight. Higher prices, shrinking savings, endless cycles of boom and bust that feel less like natural phenomena and more like a leash. Yet even the most sophisticated systems of control carry within them the seeds of their own collapse. No empire of debt can grow forever. No currency can be manipulated endlessly without consequence. No structure built on confidence can survive when confidence finally breaks. The Federal Reserve's power is vast, but it is not immune to the forces it manipulates. The more aggressively it intervenes, the more fragile the system becomes. The more fragile the system becomes, the more inevitable the reckoning. And that reckoning is coming. Maybe it arrives through runaway inflation that devalues everything Americans have worked for. Maybe it comes as a deflationary spiral that exposes how hollow the economy has become. Maybe a global shift away from the dollar forces the Fed to confront limits it has denied for decades. Or maybe the public, weary of opacity and manipulation, begins to question the very foundations of the monetary order. History shows that no central authority, no matter how powerful, can maintain control when the illusion of legitimacy dissolves. But this is not a story of doom. It is a story of awakening. Because the moment people recognize the mechanism, the spell breaks. When they understand that money is not neutral, that policy is not objective, that crises are not accidents, they reclaim the one advantage the system fears: clarity, awareness, the ability to see the machine for what it is. And once the veil lifts, the path forward appears. Not simple, not easy, but real. A future where value isn't dictated by a small circle of decision-makers. A future where money cannot be inflated at will. A future where citizens, not institutions, define the boundaries of economic power. The inevitability is not that America will remain under the Fed's control. The inevitability is that systems built on imbalance eventually give way to something new. And whether that new world is chaotic or liberating depends on what people do with the truth now unfolding before them. If the past century has been a slow descent into centralized control, the coming one may be the moment of reversal, when the public finally sees the trap, steps beyond it, and realizes that the power they thought they lost was never truly gone. It was merely obscured. The first step is understanding. The next is refusing to look away.